So good afternoon, all. For those who are the most patient and strongest audience part of this conference, I can promise you that we will have an insightful closing discussion on really key importance topic, which is access to finance. So financing is a lifeblood to all the businesses. So financing catalyzes ideas to become reality. It drives scales-ups, startups, and well-established businesses to the full potential. So Europe historically was covered and around the banks, and Lithuania, as well as the Baltics, while no being any exception here, distinguishes themselves with a highly concentrated banking sector. Just a bit of statistics. So concentration of the banking sector in Lithuania last year was around 71%. And this 71% of market share was taken by three major banks, which is similar situation in Estonia, where three major banks took around 75% of the market share. But the difference between Estonia and Lithuania is that Estonia managed within the 3 years to reduce concentration by 10%, from 85% in 2019 up to 75% in 2022. So what are the difference, taking into account that Lithuania has 7 newly established banks within the last 6 years? So having highly concentrated banking market led to limited access to the banking lending to the business. Although concentrated banking sector is not automatically limiting financing sources and logically thinking demand fuel supply, there should be alternative sources for financing well developed, for instance, capital markets. Let's take a look, very brief look, about the capital markets in the Baltics. Well, the picture is not super encouraging. If we take the statistics again a bit off, market capitalization to GDP last year in Lithuania was 9.1%. In Estonia, it was 16.1%. Meanwhile, in Latvia, it's only around 2%. And that shrank, I would say, really dramatically, comparing with 2015, when we have in Lithuania market capitalization to GDP, which was accounted to 33%. So what happened? To address those issues in capital markets, we definitely see the real actions, and I would say first time in Lithuanian history, united efforts between all stakeholders in Lithuania to improve, to enhance capital markets. So one of the examples is a formed Capital Market Council, which is responsible to make a gap analysis and action plan what is needed on legal taxation infrastructure side in order to promote capital markets. Then what we saw also, the strong collaboration and contribution coming from European Commission, where together with EBRD, European Bank for Reconstruction and Development, created a new fund, Capital Markets Development Accelerator Fund, which aims to increase liquidity for small, medium enterprises seeking to raise capital in capital markets, public capital markets. And finally, we see some kind of debates on the legislation side about the taxation, about the investment account, which also would be a stimulus. Well, we can discuss how significant or how relevant they are, but again, addressing the point to promote capital markets, to involve retail and corporates to enhance our Baltic capital markets. And finally, what was recently last month announced, the new MSCI Baltic Index, which was set specifically for the Baltic region. Nevertheless, our Baltic capital markets, they're still classified as a frontier markets, and my dear and esteemed panelist will comment on that as well. So what it means for Lithuania, whether it's good or bad, comparing with regional capital markets and globally. And finally, if we have limited banking lending and we have illiquid frontier capital markets, so the third source of financing in our region is investment funds. So here, the picture is much better and more encouraging. Just very few statistics here. Since 2019, total value of the assets under the management grew more than twice. So if in 2019 there was around 800 million assets under the management, so in 2022 it exceeded 2 billion. So that's quite encouraging growth of this sector. And by the way, the investment funds were, I would say, one of the most proactive in capital markets by raising funding for their own developing projects. So having this very general, high-level observation, I'm really very eager to kick off our discussion. And before we go to the questions and discussion with the panelists, I really encourage you to send the questions, which I will raise at the end of the panel, to our panelists. So Jiri, may I start from you? So what would be your view on the current state of the capital markets globally and on a regional level?
So first of all, I think this was a great introduction. So I think you have covered all the important topics. So happy to go into more detail. Pleased to be here. As introduced, I am responsible for our business in Central Europe, and we like Lithuania. We support the debt raising effort of the Republic. We led the Ignitis IPO, which was the largest one for quite a while. 3 years ago, we brought to the Eurobond debt capital markets some of the biggest corporates in the market, which included Ignitis, Avia Solutions Group, Maxima, or Acropolis. So, I think Lithuania is an attractive market. It's a Eurozone membership. I think Euro currency is definitely an advantage. We see, high technical base, high technical education, the connectivity with the rest of the European Union, hard-working culture. These are all factors which investors like. At the same time, capital markets, and in particular equity capital markets, is a question of size. So it's not an issue which is limited to Lithuania only, but we see it in other countries in the region as well, and that is to attract the investors from London or from New York, which can invest with tickets which should be at minimum 10, 20, 50 million, in some cases $100 million, and at the same time not exceed sort of 5 or 10% of the overall free float, because then it would be difficult to get out of the position. So if we look at a few numbers which we track, comparing the 3 Baltics markets, we see listed companies here, 48. In Warsaw, we see 324. In London, we see on the main market 574. So the difference is, I would say, corresponding to the size. But the nature of the issue is in the what we call the free float market capitalization. So those are the effectively available shares for trading. So if we look again at the Baltics markets, we come to a number which is roughly $3.5 billion. But then Warsaw is now not 6 times more, but this time it is 50 times more, and London is close to 1,000 times more. And that is the core of the problem, because then these big investors do not have the incentive to spend time on issuance in the region, because it's simply too small from the risk management perspective, as well as from the overall capital allocation perspective. So that is, I think, if there is an improvement, and I heard and read also personally about the initiatives which I think go in the right direction. I think we should not forget that the trend is positive. I mean, if we look at the last 5 years, there have been, 11 debt raisings by Lithuanian incorporated companies, whilst in the previous 5 years, from 2013 to 2017, there were only 2. So, I think the trend is positive and nothing will come automatically. I would say that what is also important to note is the growth of the companies, and what we see in Lithuania as well as in the other Baltics markets is disproportionately high growth, which is positive, whether it's organically or inorganically by M&A. This growth is very important in the medium and long term to generate more and more companies which have the size for the international investors to look at, regardless of the location, whether the listing venue is here or whether the listing venue may be somewhere internationally. So I think that's, again, a very positive trend, especially in the context of what I would call the technological companies. So that's maybe the introductory sentences from my end for the topic.
Thank you, Jiri. Žilvinas, and coming to you, could you please share the slides? Yes, we do have. Yes, here we have. Could you please share your general overview about the global and regional capital markets, especially of the importance of capital markets classification and how Baltics looks in the picture of the regional capital markets?
Okay, thank you, Eva. Thank you, Rolandas, for a very kind introduction. I have a difference of opinion. I respect the legal profession in other countries, especially in the countries where they have different taxation. Not as big of a spread, but we're in full respect of the profession, and it's key to democracy and capital markets. So I've been in capital markets now 22 years, and that's one of the reasons why I'm less here, because in my business, 99% of my activity is in developed capital markets in terms of buying and selling companies, leading research departments, and et cetera, et cetera. And I spend few percent of my capital and time on emerging markets and very little time in frontier markets, which is very consistent to what he said from an investor's, what Jiri said from an investor standpoint. Now, the difference between me and him is he made money in Ignitis, I lost also. Meaning he was sold and made a commission, I bought and I took a risk on price. Bankers made money and investors have to hold it for a long time to get their cost of capital. I just happened to sell it. But I did participate in it, but it just didn't meet the criteria, we didn't see the idea, and et cetera, et cetera. So it is extremely complicated to talk about capital markets in Lithuania because it's been 30 years of a lot of fun, selling ourselves to few nice guys in Sweden, Denmark, then Danish left, then Norwegians came. But the result is the banking reliance on good neighbor Sweden worked. And it was very low cost of capital and accessible cost of capital over a long period of time. However, right now the debate is here, but that's partly why we're discussing it, and I'm open to discuss it more in the future, is the fact that when something changes to home country of a bank like Sweden, and they have an issue with the real estate, whatever they say on PR business, it will affect the lending in peripheral markets for them. And Lithuania is peripheral market to Sweden, and what happens in banking crisis or real estate crisis, which we're experiencing now because of high rates in Sweden, we see capital reduction in the peripheral markets for them. And that is the price we're paying of not having had capital markets focus or diversification. The reason, now, it is just to start, and I want to get into questions, is that capital markets, basically, there are 3 pieces to capital markets that we need to get and which bucket we're in and what it means for cost of capital to business. So in this slide, I just say that basically there's three categories that are critical, which is developed, emerging, and frontier. And Lithuania is in frontier. And that is not just, it's extremely small percentage of total capital that's allocated to the bucket. Now, what has been happening in capital markets past 10, 15 years, you may have heard of BlackRock becoming 10 trillion organization, etc. So what has BlackRock done is been killing people like me who are active investors. And other active investors also started following more of indexes and passive flows. So passive flows is not just because of BlackRock or Vanguard going into markets based on their criteria, which is driven by MSCI and S&P largely in the world. And it's also that actives are following them to outperform or underperform. So basically, it's either you're in the right bucket or you have no chance to get to that capital. And that's been becoming clearer and clearer and clearer and clearer. So Lithuania sits in this smallest bucket, and there are examples, and this is what we're going to discuss later. Some countries have awareness of it and have a strategy to jump the bucket. So there are some successful scenarios, which we're going to delve into maybe later, and some not. But what it largely means, and I will go to the slide a bit further, is that basically it means here. So Vilnius Stock Exchange with 4.6 billion capitalization, 500,000 daily volume. Again, I just took the PEV of the largest companies that I'm able to get profits. To get to the cost of capital, you roughly divide by 1, and you get it's around 15% cost of capital for equity implied. And Vilnius and Romanian one are in frontier, and Prague, Athens, and Warsaw right now in emerging markets. So the difference is extremely high. And now, I do want to jump into this topic that countries need to make awareness and do, but I will leave it to you. Mm-hmm. The point is, I just want to make one clear point that capital markets have been concentrated and very dependent on criteria. And unless policymakers understand that unless you focus on it, some countries do focus, some don't, and I don't think Lithuania does, and we can discuss that why and what and etc. If you're stuck in that bucket, nothing will change in capital markets, i.e. the new capital will not flow in, etc. And the main risk that we are facing in this country is that we have these amazing, talented startups and etc. When they raise capital, they will go and sit there with African companies in London, which has happened to my friend, at Auga, who went to London Roadshow, and he was sitting with Mozambique companies, not with Romanian companies, Czech companies, etc. in the room, he's competing with capital by bucket, not because he's good or bad in capital markets. So that's just kind of main point of the context. And I will go into more specifics.
Very good one. Because I have immediately the question. So you mentioned one of the sort of reasons of having really illiquid and frontier markets that Swedish, or in general, Scandinavian investors took over the banks in Lithuania and the Baltics, meaning that creating this concentration. So we can leave this a bit aside. But what other obstacles you would identify or that impede or impeded or still impedes development of the capital markets? And by the way, Žilvinas, should we discuss about Lithuanian capital markets, or should we straightforward go to the Baltics, if it makes more sense from your perspective?
Well, I don't believe in Baltics. I think, unfortunately, classifications have to do with countries, not regions. So you cannot have like S&P or Moody's applies very good investment rating to your Lithuanian government bonds, which trade very well and very competitive spreads to Germany and etc. And was extremely successful bond. But equity markets go by country jurisdiction, whether it's you cannot run away from that country point. Now, so maybe it's just unfortunately Baltics will not help.
Okay, and what's your view?
I would want to make two comments, if I may. So first of all, the passive tracking of funds and of equities have become more and more prevalent, and the technical analysis as such. So, the point that has been made is valid, because in some companies we see, that half of that is owned by passive funds, and then even when you go on roadshow, and we work in the context of major M&A, we go to meet with investors and we tell them, well, this is a great idea, there is a shareholder vote, you should support it. And we are surprised actually how many of these investors then actually tell us, well, actually, we are passive tracking, we will not make our own view, but we will rely on the proxy advisor to tell us how we should vote. So that's point number one. So it is an important point which has been made. The second important point about MSCI and the bucketing into the three buckets, it relates, we have now focused on the country level only, because there is simply not enough companies that would even make the index. But then in countries where you have more than 3 companies which fall into the MSCI, it's a big battle actually who makes the cut for the country. So being inside the MSCI index, and and there is difference indeed, a big one between developed, emerging and frontier, but being inside the index, whether it's one of these 3 or being outside, that's a big difference for the particular company and how it is traded and what its share price and especially daily volume is doing.
So that's, and following this logics and going to that direction, if we discuss now about concrete Lithuanian capital markets and concrete steps to be made that would sustainably lead to some kind of success. First of all, Žilvinas, if I understand correctly, we're talking about upgrading in classification. So in that path, what steps you would do in the shoes of the government of Lithuania or other stakeholders in order to move there?
Okay. So it may, given the consensual thinking in Lithuania where we stand, it may just sound radical, but I will just tell you one thing, that 2 countries have done it. And I am investing in, for example, Greece. Greece even did elections to change to make sure they get investment grade and etc. and classification from emerging to developed. So we've seen policy in capital markets kind of driving policy, and in Greece would be the most famous example of, they even called an election on it. And that was the reason the Prime Minister wrote to the President, was capital markets. It was very kind of, you can have like an extreme example which makes policymakers comfortable to say capital for the countries, for the companies is an important thing, which it is. We're competing for capital with others. So secondly, we see Romania doing the same thing, and Romania is now in frontier, which is like Lithuania, and I have even done work here on it. So you will see that Romania, and we can do, that's the answer. So Romania just listed hydroelectric. I don't know if JP Morgan was on it.
No.
But, sorry for that. So
no,
basically,
it was a conscious decision. We didn't want to.
Yeah. So basically, we can see that they just IPO'd Hidroelectrica, which was state-owned for a very long time. Obviously, politically, there's many reasons in countries people don't want to sell minorities, but right now they're based on this criteria that I'm trying to summarize, extremely complicated topic in the best I can, is they're starting to meet these requirements, and they're gonna be very likely upgrade from frontier to emerging markets, which will be enormous leap for capital markets. Mm-hmm. So what they have done, which is the only path here, is that you have plenty of state-owned companies that are, like Ignitis is listed 20% free float, why not 49? There's no difference. Banks, for example, banks would be more controversial. To me, banks are not private companies. They live on kind of, they're using the society and deposit guarantees to collect money from people. To me, they're quasi-state companies. Like utilities, you don't have to own them to regulate them. You can regulate the tariff, like any other state. So The fact that you have to own it, or Sweden has to own 100% rather than 60%, is their problem, not the country problem. So all state-owned companies are quasi-utilities. So bank to me is a utility as much as electric company, because it's at the whim of a regulator. They will tell you otherwise, and there's a big PR here by the Swedish banks, so taking a bit of a risk here. So the point is, you just say list 30%. There are few countries. I just don't want to be mistaken. There are, I think, even in Czech Republic, there are banks are listed like minority. There is a conscious decision that you have to list 30%. So it's not only helps the capital markets and the number of names and liquidity and etc. to meet the activity, but it also helps transparency, and especially in banks. If banks were listed in Lithuania 30%, we would have the accounts, would have analysts tracking what's happening between Sweden and Lithuania. So there's many other benefits that happen. But
for the society.
For
but
the
what
society,
about issuer?
Well, it's their problem. They're already pregnant.
Well, but maybe that's the problem that, if we create some kind of really attractive issuers, but liquidity still stays in the same low level.
No. You increase the number of people listing, so it's very good for bankers and lawyers, by the way, and for investors, so we're all winning. And society wins because you have more companies to invest, and you can make a decision to force them to list minority stakes up to 50%.
I think one needs to be also careful with listings because public flotations need to be done properly, and you do not want to have what we call orphan stocks, where there is effectively limited trading. It's technically listed, but there is limited trading, and what it does then, it effectively burdens the company, because obviously the disclosure and regulatory requirements are much stricter than for a life of a private company, and typically it also has the opposite effect on the share price, because if nobody buys it, the share price goes only in one direction, and it's not the direction that you want as the majority shareholder. So I think if companies go public, it needs to be for a reason. The reason can be several-fold. Typically, you would list if you reach a size and you want to have to build a different additional pillar to funding sources. So obviously, being listed helps you tap the capital markets when you need it, and you don't rely on your banks only. It obviously also increases visibility, corporate governance, and has additional effects. And if you do everything correctly, the share price should go up. I think a good example of how capital markets promotion has been done properly is Poland. Poland, when you look back 15 years ago, was clearly tracking behind Vienna, and Vienna was the biggest stock exchange in the region. I still see Vienna as a part of Central Europe, not only geographically, but also because of the economic ties. Then the Polish government has made a coordinated effort how to promote the stock exchange, how to incentivize state-owned companies to come to the stock exchange, and effectively it's a spiral. When you have more companies, more investors come, it becomes a more friendly marketplace for foreign players, and then also private companies are incentivized when they see the success and when they see that this all works to come to the markets as well. So now Poland for us is a good example of how it's done, and they have achieved the target to overcome Vienna in terms of attractiveness of a stock exchange. But I think if I would say that one needs to be careful and clearly take a conscious decision when it is right for the company to go to the capital markets and when it's actually better to stay in private hands.
So that's the problem is the Lithuanian companies which feel that they are ready to be listed, to become public. So typically they are big ones, and they primarily do listing not here in our capital, in our stock exchange. And the reason is very simple. lack of liquidity here.
I understand that.
So that's how it's a bit, egg and chicken situation.
I get that, and it's obviously not easy, especially in the context of a relatively small market. But then I think I gave the Polish example for a reason, because if you have the government supporting the listings and leading the way with some of the state-owned companies, it's then obviously easier for the private companies to follow.
Please.
Yeah, I think it's a catch-22, because state needs to facilitate capital markets, because we face a risk that our fintechs and other companies that are small, they will not care, right? At that point, when they need to raise capital, they will just go to whatever the capital is. And it's very easy for them to change legal jurisdiction, and etc. So we don't want to wait for these companies to make a decision, because right now the decision will not be Vilnius, 100%. So, or unless they're extremely patriotic, which I wish, but logically they will not, for the billion-plus listing.
It's impossible.
Yeah, so even from a prudency standpoint, it's just not going to happen. Now, the point is, and in Poland example, if we see biggest companies that we know, all the utilities, PGE, Tauron, etc., they listed, previous government before PiS, listed all of them to facilitate it. And they, PKN is listed, the one that owns Mažeikių Nafta. You have all the utilities listed, PGE, Tauron, Energa. I participate in all of them. And then, obviously they're not forcing the bank subsidiaries to list, but I'm just saying in Lithuania, because we face, we face this statistic of the largest, we're winning in something, the largest rejections of loans in Europe last year. So because of that, it could be a bit innovative. And again, banks need capital, right? So exactly. Banks is separate from state-owned companies. So what we both agree is you need to facilitate somehow this market. And Polish example is phenomenal, but that is listing 50%, 49, 60, doesn't matter. Because the minute it comes to the private companies that we're so proud of, they will not wait. So it's either it's there, or they will do it whenever they think it's prudent for their needs.
But Žilvinas, just looking back to the history, so we had this famous telecomas privatization and IPO, which in my opinion was a bit of fiasco because it ended without nothing, and the price and value declined immediately and really painfully. So we have Ignitis, Telekomas, Klaipėdos Nafta. So there is some kind of steps, looking back to the history that were listed. But again, my question is whether we should be more patient by waiting some positive results, or there are some kind of, maybe mistaken actions or not relevant actions taken seeking to approach the goal to somehow stimulate capital markets. Because I totally agree with you that you need to have actually both, an egg and chicken. So you have to have issuers that would attract investors, which would increase liquidity. So that's quite naturally. But how to get to that point that liquidity would be enough for the issuers to be listed here in our country market, and then that investors would see our country as attractive one to invest.
If I may start just very simply, sort of the examples from other countries show that it's not sort of a magic wand, one measure do it all. That doesn't work. It's a concentrated, coordinated effort which definitely stretches to over a decade, but one needs to start. Sometimes needs to start with measures which will make the capital markets an attractive route from tax perspective, from diversification perspective, which will where the state will support not only in terms of legislative and tax framework, but also in terms of potentially bringing state-owned companies on the stock exchange, which would help move Lithuania from the frontier index into the emerging one that brings more investors because it's more tracked. So it's a spiral, but it's not coming overnight.
Absolutely, absolutely. And Žilvinas already touched the point about banking lending and having those 2 minutes left, but I'm really curious to ask you both about what your view is about the strategy, or at least really big efforts of the state of Lithuania, which last for, I would say, 6 years already, to attract some big legacy banks, new banks in our country, which would help to increase competition and to reduce concentration in the banking sector. Is it a sustainable strategy, viable and reasonable for Lithuania, taking into account the size of the market and 6 years of the efforts that, yes, it brought other good effects? We are globally known as a fintech hub. We are well recognized. Our reputation is really good in terms of the fintechs, in innovation, in financial services. But the actually underlying sort of reason which pushed this strategy was a bit different. So is it still worth to go that direction, or we should change our attitude and look to a bit different areas, how to increase accessibility to funding and financing in Lithuania? So Žilvinas, Jiri, who would like to start?
I don't have a view about the banks. I only think about capital markets. I think we have plenty of banking exposure. Another bank, I don't know. I think every investor is good, yeah, sure, but
it doesn't
I think we should just be aware that we haven't even talked about these capital markets in a serious way, other than some small club having a debate occasionally. So there's no serious debate about capital markets. Of course, every investor is welcome, yes. But does it change anything? No.
So it means that it could be, if I could translate what you just said, so it's worth to focus more on capital markets and to leave banking.
I'm stating what's reality now. I don't know.
I do have a view about the banking sector. I believe that concentration is not necessarily bad in a banking sector, because one needs to keep in mind that obviously banks size matters, right? I mean, a bigger bank, if run properly, is more stable, and obviously we are moving in cycles, so banks need to have buffers. The costs associated with the risk models, with the regulatory, are ever increasing, and it is easier to be borne by bigger banks than by smaller banks, and a healthy banking system overall is a backbone of any economy. I can give you a Czech example from the 1990s, where the banks were not run properly, and then the state had to bail out the banking sector with more than 30 billion euros of 2000 euro currency. So that's definitely not where you want to go. So from that perspective, yes, competition is definitely good. I think it's always healthy to have new fish in the pond, but at the same time, we need the backbone of the economy. So I think the incumbent banks definitely have a place in the banking sector, and the fintech is very healthy, is helping bring new products, more innovation, and is putting pressure on the incumbent banks to follow. But I don't think that any economy should go from one extreme to the other.
Thank you. And I have one question, not one, I have a few questions coming from the audience, and the question that I want to raise is actually addressed to Jiri, but I guess it would be fair to ask you both, because it's very relevant about who should sort of take the lead in developing or leading the project, how to develop capital markets in the region, in Lithuania. Should it be NASDAQ as a stock exchange? Should it be Bank of Lithuania as a central bank, or the government, or there should be someone else, or combination of all of them?
I will repeat myself, but this is not one solve-it-all solution. This needs to be a coordinated effort by...
Who should coordinate? I mean,
who should coordinate?
In your opinion?
it's obviously where the executive power lies, and that is with the government or with the regulator. But I don't think it's possible to do it without really coordinated effort of all these constituents.
Absolutely. Žilvinas?
Just awareness by the Prime Minister on talking about it. Yes, executive has to set the tone, not the stock market. Stock market is perceived to be a conflict of interest. They want to develop stock market. So yes, somebody has to lead, but it has to be from the top.
Absolutely. And actually, Japan's example is a good example of that, when the government took the immediate actions to increase liquidity and to increase and motivate the state-owned companies to be listed in order to stimulate the local capital markets. So that could be one of the ways or examples to, of course, it's not the perfect one, but at least it has good certain lessons that could be followed by Lithuania. So thank you so much.
Thank you very much for having us.